Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex financial world and reveal the secrets embedded in corporate filings. Today we are diving into Range Capital Acquisition Corp Dessous quarterly report their 10Q filing that gives us a snapshot of their financial health as of the 30th of September 2025. Get ready because this report is full of interesting details about a company looking to make a big splash. Before we jump in, if you love getting these straight shooting insights from real corporate documents, make sure you are subscribed to the channel. And if you want to connect with other finance enthusiasts and get even more exclusive content, join our Discord community, linked in the description below. This report is from Range Capital Acquisition Corp Dessous, and it covers the third quarter of 2025. They are a blank check company, a special type of company that goes public with the sole purpose of finding another company to merge with or buy. Think of them as a financial matchmaker for businesses. Let's start by looking at their condensed balance sheet as of the 30th of September 2025. This is like a snapshot of what the company owns, what it owes, and what's left over for its owners at a specific moment. Right now we see that their total assets are just under $300,000. That might seem small, but it's important to remember this is a company that has just completed its initial public offering, or IPO. Much of this is tied up in offering costs and accrued expenses. On the liability side, we see a promissory note from a related party totaling over $132,000. This generally means the company borrowed money from someone closely connected to it, like its founders or sponsors. It's a common way for these types of companies to fund early operations before their big IPO. Now, for the shareholders' deficit, which sounds a bit scary, but it's typical for companies in their early stages, they have an accumulated deficit of about $50,000. This simply means their expenses have been higher than their income so far, which is perfectly normal for a company focused on finding an acquisition rather than generating immediate profits. Moving over to the operation statement, we see the heart of their activity for the quarter. For the 3 months ending the 30th of September 2025, they reported formation general and administrative costs of about $37,000. And for the entire period from their inception on May 22, 2025 through the 30th of September 2025, these costs reached almost $50,000. These are the costs associated with setting up the company, getting it ready for the IPO, and all the necessary legal and administrative work. Because of these costs, they have a net loss. For the quarter, the net loss per Class B ordinary share was a penny, and for the period from inception to the 30th of September, it was also a penny. This is expected given their business model. They are not selling products or services yet, they are building the foundation for a future business combination. Looking at the statement of changes in shareholders' deficit, we see how the ownership structure evolved. Initially, there were no shares issued, but then over 7.6 million Class B ordinary shares were issued to initial shareholders. These are often the founder shares, giving early investors control and a stake in the company's future. The amount associated with this issuance was just over $767 for the shares, and an additional $24,233 in additional paid-in capital. By the 30th of September 2025, the company's total shareholders' deficit stood at a negative $24,800, which, as we mentioned, reflects their early stage and pre-revenue status. The cash flow statement provides insight into how cash moved in and out of the company. From May 22 to the 30th of September 2025, cash used in operating activities was around $32,000. This was mainly due to their net loss offset by adjustments to changes in operating liabilities like accrued expenses. On the financing side, they saw an inflow of $25,000 from the issuance of founder shares and another $132,000 from that related party promissory note. They also made a payment related to deferred offering costs, but overall the financing activities brought in more cash than was used. Now let's delve into the notes that accompany these financial statements. Note 1 explains their organization and business operations. Range Capital Acquisition Corp 2 was formed in May 2025 in the Cayman Islands as a blank check company. Their goal is to find a business combination, as they call it. Importantly, they had not identified any specific target business as of the 30th of September 2025. Their activity up to this point was all about preparing for their IPO. They will not generate operating revenues until after they complete a business combination. This report details their initial public offering, or IPO, that was declared effective on the 30th of September 2025 and then closed on the 6th of October 2025. They sold 23 million units at $10 per unit, raising a massive $230 million. Each unit contained one Class A ordinary share and half a redeemable warrant. They also had a private placement where they sold an additional 660,000 units to their sponsor Range Capital Acquisition, Sponsor 2 LLC, and BT LLC, the underwriters for another $6.6 million. The costs associated with this IPO were significant, totaling over $13 million. This included cash underwriting fees, deferred underwriting fees, and other offering costs. These are standard but substantial expenses for bringing a company public. Crucially, after the IPO, a substantial portion of the proceeds, over $230 million, was placed into a trust account. This money is meant to fund their future business combination and is protected from general business expenses until that combination is completed or the company dissolves. They must complete a business combination typically within 24 months or the funds are returned to shareholders. Note 2 details their significant accounting policies under deferred offering costs. We see almost $290,000. These are expenses directly tied to the IPO, like legal and registration fees. If the IPO is successful, these costs are transferred to shareholders' deficit, but if it fails, they are charged to operations. Interestingly, as a Cayman Islands exempted company with no operations yet, they face no income tax and have a tax provision of 0. This is a common structure for special purpose acquisition companies, or SPACs. Note 3 dives deeper into the IPO details. It reiterates the 23 million units sold, plus a 3 million unit over allotment option, which was fully exercised. The warrants have an exercise price of $11.50 and are exercisable typically 12 months after the IPO closing or 30 days after a business combination closes. A key feature for warrant holders is the redemption clause. The company can redeem outstanding warrants for a nominal price if the Class A ordinary shares reach $18 per S-share for a sustained period. This creates a potential exit or conversion point for warrant holders. Note 4 talks about the private placement where 660,000 units were sold to the sponsor and BT. These units are similar to the public units but come with restrictions on transferability until after a business combination. This is a way to align the interests of early investors and underwriters with the company's long-term success. Note 5 highlights related party transactions. It details the issuance of 7.6 million founder shares for a nominal capital contribution. Up to 1 million of these shares was subject to forfeiture if the underwriter's over allotment option was not fully exercised. But as we saw, that option was fully exercised on the 6th of October 2025, so those shares are no longer at risk of forfeiture. The company also had a non-interest bearing promissory note from the sponsor for up to $250,000. As of the 30th of September 2025, they had borrowed over $132,000, and this total amount was repaid at the IPO closing. This shows how the sponsor injects cash to cover early operational costs. It also touches on a transfer of founder shares to the company's CFO on the 17th of September 2025, valued at nearly $122,000. This is a common practice for compensation in early-stage companies. An administrative services agreement was put in place on the 30th of September 2025 with an affiliate of the sponsor to pay $20,000 per month for office space and support. This fee stops upon business combination or liquidation. At the 30th of September, no fees had been incurred yet. Note 7 details the shareholder structure. There are no preference shares or Class A ordinary shares issued or outstanding as of the 30th of September 2025. All the shares issued are the 7.6 million Class B ordinary shares mentioned earlier. These Class B shares will convert into Class A shares, typically on a 1-for-1 basis upon a business combination. Note 8 explains segment information. Since Range Capital Acquisition Corp. is a blank check company with a single objective, it operates as one reportable segment. The chief operating decision maker reviews the company's performance as a whole. The key metrics they focus on are formation, general and administrative costs to manage cash for the business combination, and total assets to ensure they have enough resources. Note 9 covers subsequent events up to the 7th of November 2025. The most significant event is the completion of the initial public offering on the 6th of October 2025 as discussed. The IPO generated $230 million in gross proceeds, and the private placement generated another $6.6 million. The amounts placed in the trust account were $230 million. Transaction costs were substantial at over $13 million, including a cash underwriting fee of $4.6 million and a deferred underwriting fee of $8.05 million to be paid upon the completion of a business combination. Also, the $207,000 promissory note borrowings were repaid at the closing of the IPO. Now for my take on Range Capital Acquisition Corp. II. This report paints a picture of a company very much in its early formation stages. Their primary objective is crystal clear executing a business combination. The financials reflect this focus with significant IPO related costs and no operational revenue. They have successfully completed their IPO, raising a substantial amount of capital, which is a crucial first step. The capital is largely held in trust, ready to fund their acquisition strategy. The risks are inherent to SPACs. The biggest challenge is finding a suitable acquisition target within their timeframe and convincing shareholders it's a good deal. The associated underwriting fees and offering costs are large, chewing up a significant chunk of the capital raised. However, the structure with the trust account provides a safety net for public investors, offering a path to get their initial investment back if a deal isn't struck. The company's direction is entirely dependent on management's ability to identify and negotiate a successful business combination. The key opportunity lies in leveraging their capital to acquire a promising business in a growing sector. The main risks revolve around market conditions, the availability of attractants, and the execution of the merger itself. Given their current financial state, which is typical for a pre-IPO company, the focus should remain on their strategic execution rather than short-term financial performance. Overall, Range Capital Acquisition Corp. is in a transitional phase. They have successfully navigated the IPO and are now poised to pursue their acquisition goals. The capital raised offers significant potential, but the success will ultimately hinge on the quality of the business combination they can achieve. Alright, that's our breakdown of Range Capital Acquisition Corp. IS latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comment. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.